Hello, everyone. We are excited to have a conversation around private equity within our portfolios. There's a variety of ways that investors can get exposure to private equity markets. What we want to cover today, both Brock, myself, and then Matt Demetrison, our CIO, is how we see private equity fitting into portfolios, where the private equity market is at today and relative to the last handful of years, the opportunity we see within private equity complementing what exposure we have as the majority of our exposure in public securities, both across equities and fixed income. And then specifically one fund, which is a private equity fund called Bow River. And how we went through the due diligence process, what we like about the team, the exposure that we're looking to add within Bow River, and then the construct of the fund that we're looking to add to the portfolio. So we have Matt Demetrison, like I said on the call, he's our CIO. He obviously heads up our investment committee, and the investment committee that has about 8 to 10 individuals on it, of which Matt leads. So I'm going to pass it over to Brock briefly, and then we will run through a handful of slides.
Thanks, Craig. Thanks for joining, everyone. This isn't something that we've shown you a lot over the history of what was Miracle Mile, now rebranded to Composition Wealth. Public equity markets have done incredibly well. The backdrop for their growth and performance over the last, couple of decades now, really kind of kept us away from needing to accentuate portfolios and diversify portfolios into a lot of the private space based on the needs of a lot of our clients. We think that the forward-looking opportunity in the private space is very attractive. And we introduced some private debt investments to the firm and our group. Now we're starting to talk about private equity. Couple reasons why we have the team that we have right now. Matt Demetrison is leading a very strong team. They have a ton of experience in this area, and so with the team that we have, with what we see as an opportunity in this space, it is our job now to really just bring to light why this, why now, how, what areas are we most attracted to in the private equity space? It's a large space. And Matt's going to kind of go through the whole thought process, and we'll be here to follow up with questions and talk specifically to each client about what we think is appropriate for each client. Matt?
Thanks, Brock, and thanks everybody for tuning in. And just to elaborate on what Brock talked about here. So if you look on the chart on kind of the left-hand side, we kind of look at returns. And so we look at the past 5 years of returns, and you look at the MSCI World Index, which is just a broad benchmark of stocks across the globe, public companies, and they've returned almost 14%, not that much behind private equity at 15.6%. And so the way we look at that is we think if you're going to be invested in the private markets and locking up your capital where you don't have daily liquidity, you should be compensated for that with an illiquidity premium. And at 2 percentage points, that's not that big of an illiquidity premium over the last 5 years. But as Brock mentioned, our view going forward, given that publicly traded stocks are trading at pretty high valuation multiples, and we kind of seeing more of a plateauing in economic growth, we don't expect the next 5 years to be as great as the last 5 years. We still expect to see positive returns, but in a more moderating pace. Yet on the private equity side, and we'll walk through some of those drivers in a second, we see more attractive drivers for their upside potential over the next 5 years. And we actually expect to get a wider illiquidity premium, meaning you're going to get paid more from locking up that capital and not being able to exit it on a daily basis. And so that's kind of shown with our projected 5-year returns. The other thing I want to highlight just on private equity returns, this chart on the right looks at what they call annual vintages. So if you look at the left line, it would be private equity funds that started investing in 2000, year 2000. Typically, a private equity fund may take 3, 4, 5 years to be fully invested. That's why this chart only goes through 2020, is because some of those funds haven't been fully invested beyond 2020. They're still in their process of allocating their capital. But what you tend to see is an average return of 15. Sometimes it's above, sometimes it's below. But because those funds are invested over a multi-year period, you tend to get this smoothing of returns. So you get that element of it, and you can kind of see those return profiles over the years. But on top of that, you actually get a wider range of outcomes. And so you actually can get compensated for picking the right private companies or the right private equity funds. So as we delve into that a little bit further, if we look at the next slide, which can maybe take a step back and look at just how does private equity funds typically work? So a more traditional private equity fund is what they call a drawdown structure. And this chart on the right kind of shows it. You start out with this liquid portfolio called 60% stocks, 40% bonds. You subscribe to a private equity fund, say you're going to put in $500,000 into it. That gets called over a number of years. Usually, again, a fund will have anywhere from 3 to 5 years to invest that. So in this example, you'll see in the first year, only 19% or about $100,000 worth of that $500,000 commitment gets called. Year 2, you're up to 37%. So an incremental 18% or just under $100,000 gets called. And it takes you really until year 5 where you get fully committed. In this case, some funds will call all 100%. Some may not need to call all 100%. This example just shows a fund that will call 84% of your commitment. And then over time, as businesses are sold and capital gets returned to you, and you kind of wind it down. And so the good part of this is that you're not having to keep money in cash. When the private equity fund tells you when they need the money, you come up with the money and you put it in, so you kind of don't get this cash drag of waiting around for necessarily the money to get invested. The fund's not just sitting on that. But the flip side of it is, you want to be allocated to private equity, it's going to take you 5 years to get fully allocated in this example to the fund. And so one of the innovations that's really come about in the industry over the last 5 years, that in addition to kind of a more compelling environment today, also makes private equity investing more feasible today than it might have been 3 years ago, 5 years ago, or 15 years ago, is this concept of an evergreen vehicle, where you're already buying into an established private equity portfolio. And so all of your money's put to work day one. And so this chart on the bottom just kind of shows you don't need to have as great of returns to get still the similar, what they call, multiple uncommitted capital. It's just kind of the, compounding your money. So if you get a 2.9 multiple, that means you put in $100,000 and, 5 or 10 years later, you get that 2.9 multiple, you've got $290,000. And so what we like about these evergreen structures, when they're managed properly, and we think some solutions are better than others, they give you an opportunity to get fully invested in private equity from day one, which is an attractive trait. So let's kind of peel back the onion a little further on private equity and look at the type of private equity fund. So there's really 3 main types. The one that is most common and more known is what we would call a primary fund. So that's a new fund. It would be a private equity firm, call it KKR, established private equity firm. They're going to launch a new fund, their buyout fund 10. It's going to have a 10-year life to it. So you put your money in 2025 and you don't expect to get it back until 2035. And then KKR might have 3 to 5 years to fully invest that. So they may have up until the end of this decade to get fully invested. So they'll call that over that 5-year time period. And then over the following 5-year time period, as they, hopefully monetize those businesses, improve them, grow the value of them, they start to return the money to you. And so this creates what is, in private equity jargon called a J curve, meaning the first couple years you start to slowly commit capital. That money goes to the private equity firm. They go and they buy businesses. Usually those businesses there's something that they need to invest in the business. So there could be a problem with it. They got to put a new management team. It could be the business is going good. They just need money because they need a new, manufacturing facility to grow the business. And so oftentimes it takes 2 or 3 years to start to get that business start to on the right track, on the right footing where it's starting to grow. And so it takes a little while for the value to start to get created. And so that kind of creates it where in the back end years, you get to tend to get more of the value creation. So that's a primary fund. An alternative is a secondary fund, and that's really going out and buying the interest of somebody that's already invested in a primary fund. So I'll pick on my example earlier. It could be somebody that's subscribing to the new KKR Fund 10, but they've been in funds 8 and funds 9. Fund 8 they invested in 7, 8 years ago. Maybe they've gotten back 2 or 3 times their money. They've just gotten a small piece left. They may say, hey, I'll sell. If somebody wants to give me 90 cents on the dollar, I'll gladly sell it to them. I could use that capital and actually use it to start investing in Fund 10 that I'd like to be a part of. And so the secondary market is often utilized by a lot of institutional investors. In fact, in the news recently, Yale was commented on there selling some funds in the secondary market. They just have a large private equity portfolio. They needed some liquidity. It was not an abnormal thing that they did. But the benefit to a secondary investor is you're able to buy that at times at a discount. And the other piece of it is you're buying it further along in that maturation. So maybe you're buying it when it's 4, 5, 6 years into its life, where you have that J curve behind you. And the last piece is co-investments. And what's kind of evolved in the co-investment space is because private equity firms, charge a fee on what they do. Some institutional investors have said, hey, I'm willing to commit, $100 million to this fund, but maybe in exchange, instead of giving you 100 million, I'll give you 60. And then when you need more money to buy your business, come to me for some co-investment. Well, why would they need them to buy the business? The fund may go out and say, we're going to buy a company for $500 million because that's what we have to pay. But we really only have 300 million of capacity in our fund to use to buy that business. So they may go out to the existing investors and say, hey, if you pony up an additional $200 million in aggregate, we'll allow you to invest in that business alongside us. And in doing so, you don't have to pay us a fee. And so co-investment is an opportunity that more and more private equity firms are using to reward their investors, but it's also an ability to access private equity businesses and do so without having to pay direct fees to that private equity manager. So it's a fee-saving way to get exposure to private equity. So these are all 3 different ways that we look at and try to get exposure to. In this environment, we see secondaries and co-investments as being particularly attractive. We'll talk about that in a second. So if you go to the next slide, Craig. So let's also look at just the parts of the private equity market. So there's really kind of the larger end of the market, there's the middle market, and then there's the lower middle market. And so if you kind of look at the chart on the upper right, it really looks at revenue and growth rates. And so in private equity terms, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is often thrown around. EBITDA is really a way of looking at what's my cash operating earnings of the business. What am I earning before I have to pay my interest on my debt and taxes? And so what you see is smaller companies, so those that are under $500 million worth of value, have tended to grow at a faster rate than the larger businesses. On top of that, they tend, in this slide on the left, they tend to trade at a little bit cheaper valuation to it and have less debt applied to them. So growing better, trading cheaper, less leverage, that's a good thing. And then the chart on the bottom kind of just shows that multiple on invested capital, or how much money, what multiple am I getting for every dollar I put in. You tend to see slightly higher multiples for the lower middle market segment and middle market segment, but also a wider range of opportunities, particularly on the upside of there's just more opportunities for upside if you pick the right manager and pick the right business. So we like that middle and lower middle market of the private equity universe because we actually see them as growing better, a little less risky because of less debt, a little more attractively valued, and there's just more opportunities to garner higher performance if you pick the right business. So as we started doing our work on the private equity space, we looked at over a dozen different evergreen private equity funds. And a couple of things really came to light. We like the lower and middle market part of this private equity market. we like secondaries and co-investments. And the reason being is there's been private equity funds have had less distributions to their fund investors in more recent years. And the reason being is as interest rate costs went higher, there's been less corporate mergers and acquisition activities because the cost of debt is higher. So it's less attractive to make those acquisitions. There's been fewer and fewer IPOs. And as a result, private equity investors are sitting in funds that they invested in 10 years ago, and they still haven't quite paid out yet. And they're saying, hey, I need some liquidity. I need to cash in. That's going to benefit the secondary market. And so we expect to see an increasing supply of opportunities in the secondary market. On top of that, private equity funds have had a hard time raising capital because those same private equity investors said, I like you. I was in funds 8 and 9. I just don't have as much free capital. I can't commit to fund 10, or I'm going to commit a lower amount to fund 10 than I was initially thinking because I don't have as much dry powder. That's going to lead towards a greater opportunity for and more demand for co-investment opportunities. So we think there's just some secular trends that are going to benefit secondaries and co-investments, and that kind of plays alongside wanting to be in the lower middle market and middle market of the private equity space. So that leads us. Yeah.
Hey, Matt, real quick question here. We have a lot of conversations with clients around the number of companies going public. You just hit on it briefly, or not going public, rather. And this has been a multi-decade trend since the early 2000s. This is a way, as we see it, to get exposure to, call it, if we're just thinking about U.S. equities and our GDP, there's a large swath of companies out there that are no longer going public. Can you speak to number of companies that were public, call it 10 or 20 years ago, to today, roughly, and how and why this is a good fit to get part of that exposure, in the broader investable universe?
Yeah, it's a great point, Craig. So there used to be, or there still is, the Wilshire 5000 Index, a nice LA-based consultant in Wilshire, and it was the 5,000 largest companies in the U.S. And so, 10, 20 years ago, the Wilshire 5000 was 5,000 companies. Today, the Wilshire 5000 is only about 4,000 companies. It can't even get to 5,000. It can only get about 80% of the way there because there just aren't enough public companies that are out there. So more and more public companies were taken private and kind of fell out of the public universe. And there just hasn't been the IPO deal flow activity to really see that. More companies are choosing to stay private longer because there's less regulatory oversight to them. And they're able to kind of grow their businesses that way. And there's a lot of private equity firms that have kind of come into the space and providing different options for them to remain private longer.
Thank you.
Yeah. So the last piece is just on the valuation. And this also goes to the point that Brock made on why we actually think private equity makes a lot of sense today. We didn't think that several years ago. If you look back in 2021 or even going into 2022 before markets pulled back, the valuation, divergence between public and private companies was a lot different back then. And so here again, we're looking at this EBITDA metric, or again, is cash operating earnings. And the statistic here is the enterprise value divided by EBITDA, or cash earnings. Enterprise value is just the equity value of the business plus the value of the debt. So it's how much is the business worth divided by its cash earnings. So this multiple is a way of kind of saying, how many years worth of cash earnings am I willing to pay to buy this business? And here we look at Bow River Evergreen, which is the private equity manager that we're talking about here today. And this is their portfolio. And it's, back in 2022, their businesses were valued at about 12.5 times enterprise value to EBITDA, or valuation multiple. Today, that's inching closer to 13, but it's fairly static over that kind of almost 3-year period. Yet when you look at the S&P 500, we saw that valuation multiple go from about 12.5 to almost 17 times at the end of 2024. It dipped in the first quarter, but I can tell you it's back closer to 17 times after we've had a very strong second quarter here. And then when you look at the Magnificent Seven stock, or those big 7 tech names, those are trading at a much, much higher level. And so what we're tending to see is we've really seen this disconnect where valuations have been static in private equity space, but they've grown fairly significantly on the public markets. And so that's a key driver of why we expect more tepid return expectations out of public companies. versus private companies, they're not battling that headwind of, hey, wait a second, maybe valuations kind of compress a little bit over time. So we think this kind of bodes well for returns of private equity relative to public equity as we look out over the next several years. So now a little bit on Bow River. So Bow River is an evergreen private equity. So the attractive piece of them is you can go in and you go in day one getting access to a fully built out private equity portfolio. They'll use your capital to continue to make acquisitions of additional private equity assets. So you get kind of that day one diversification. They're going to own a little bit of exposure to those primaries or those new fresh funds, but a majority is going to be in, call it 40% each-ish, will be in secondaries and in co-investments. And the nice thing you see here is we talk about vintage year diversification. That's the year the private equity transaction happened. And you get wide degree of vintage year. What we tend to see is some years are good, some years are bad. In terms of private equity, can be on just market conditions. Going into 2020, it didn't look like it was going to be a good year for private equity, but there was a lack of deals, and you actually got pretty good pricing. And then by 2022, pricing was pretty rich and it was less attractive. And so you want kind of more diversification by vintage year. You can see it by industry. You're going to get diverse exposure. In fact, technology is a decent sized piece of it, but so is industrials. It's going to be North American centrics, but you'll get a little bit of international exposure, and you'll kind of see about 71% of the fund is concentrated in that middle market and lower middle market piece, where we see kind of more attractive characteristics and what we think should lead to more attractive return potential in those spaces.
Just one comment and a question, Matt. I know we've talked about this internally, but as we, for any clients who watch this and we speak to about adding to private markets, we certainly don't want to put all our eggs in one basket. Diversifying within private equity might look like we're looking for 5% exposure of your account to private equity, where we do 2.5% to Bow River, 2.5% to another fund. Matt, this fund, as you've described it to us, is generally, I don't want to say a beta to the market because the private equity space is so broad, but conceptually we see Bow River, the management, the due diligence we've seen, as relatively consistent and conservative within the private equity space. Is that fair to say? And can you just speak to kind of how you see Bow River fitting compared to some other private equity funds?
Yeah, I think you're right to call it beta-ish or call it beta plus. So if I think about maybe private equity returns range across the universe from 10% to 20%, just by an example, and the average fund's 15%, I would hope Bow River does 15 or 16%. And part of the reason being is because through those secondary transactions and even some of those co-investments where they're going to be buying a number of different businesses, they're going to have 100, 200, 300 over time, getting towards 300 portfolios and individual companies in the portfolio. So when they do a secondary transaction and buy a fund from, Yale as an example, if they're selling some of their portfolio off and they buy one of the funds, that fund itself may have 10 or 20, individual companies within it. Now, if you buy 20 or 30 different secondary funds, you're going to have a large number of companies in it. So that normally is going to give you really good diversification, but it's also probably going to give you, as you said, Craig, more beta or more average market-like characteristics. We think they're really good at what they do. When we looked at all 12 different funds that we looked at in the private equity space on the evergreen side, evergreen private equity funds, Bow River was far and away the most analytically rigorous, thoughtful, and detailed in how they evaluated those co-investments. We think that will add value, but when you're putting it in the context of a diverse portfolio, it leads towards a more steady return profile. I think the other thing that we really think is important about Bow River is when you are in an evergreen fund, you're putting money in, you're investing it, but you're investing it in assets that may take 10 years before you get paid back, because that's private equity. You're investing for a long term in a company. So you have to be very thoughtful about when cash comes in, where's my cash going out? Are there other investors that may need to redeem or get their capital back? Are there new investments that I need to spend money on? And so they need to be thoughtful on how they manage their cash flow and their capital. And they're among the most thoughtful, rigorous They'd rather be slow and methodical than take in a bunch of money. So they're not available to anybody and everybody. And firms like ours are one of the handful or two that really are regularly allocating to them.
And I'll just make one more comment, Brock. I can speak for both of us, and in all of our client conversations, everybody has, not everybody, but those that have private investments that they've made outside of the money that we manage for you. Typically, those are tied up. Those dollars are tied up for 5 to 10 years. We kind of describe them as more home run swings, and you typically have a portfolio of private investments of multiple of them, a lot of different investments at smaller increments, knowing that maybe 1 or 2 hit out of 10, but it compensates for the 7, 8, 9 that don't really hit. So we see them more as kind of home run swings, if you will. The way we're looking at private equity for our portfolios is complementing the public exposure that we have and looking for more, call it line drives, right? So like Matt described, the 15, 16% annualized, there's going to be years when it's 5%, there's years when it's 30%, but we're looking for a better annualized return in the double digit kind of type figures comparatively to public equities that depending on the space in public equities, large cap, US, mid cap, small cap, or international, averages 8 to 12% or so over a very long period of time. So looking to add a sliver to the portfolio of consistent returns in the double digit space, not necessarily looking for, with these exposures, home run swings 20 times, 30 times of what you've invested.
Great.
Next slide. So just on the diversification, and I think one of the attractive pieces of Bow River being in those primaries, secondaries, and co-investments is that ability to just adjust the allocation based on where they see the opportunity. And so you can kind of see that very easily just comparing 2022 in this chart on the left between transaction type and 2024. If you look at kind of the orange bar, secondaries were a smaller piece in 2022. They were a bigger piece in 2024, just because there was a big supply of secondaries that hit the market. They got some pretty attractive pricing. And so we like that ability to be nimble and go where the opportunity is in the market in any given year. The other piece is just, we talked about that vintage diversification. Not only helps just because you get diversification of what's coming to market in that year, what companies are up for sale and not, what types of secondaries are up for sale and not. But the other piece is it helps you manage your cash flow. Those investments that you made in funds that were launched in 2015, 2016, 2017, those are going to be in the stages of starting to divest a lot of those positions and returning cash flows. Those newer investments you made in 2025 and 2024, those are in their early stages, and it's going to be a number of years before you get cash back for them. So you need to kind of have a diverse array of holdings across different vintages from a cash flow management standpoint. My simple explanation on my side, it's summer and it's gardening season, is you need some seeds in the portfolio that are going to be bearing fruit several years down the line. You need some seedlings that in the next couple months are going to be bearing fruit, and then you need some that are truly bearing fruit today and being kind of providing you that yield at the moment. And that's kind of what they're trying to do in setting up their portfolio, and I think are among the more thoughtful in the space at doing so. So an example of what they would do, here's a secondary investment. There was an institutional investor that had 3 different private equity portfolios. Those 3 different funds kind of began in 2017 or 2018. This is a more recent transaction, so call it those funds were about 7 years old, fairly later in their life cycle. Bow River actually knew the underlying fund sponsor of these or fund sponsors of these 3 different funds, and kind of had some interesting insight that, hey, there were some positions in the portfolio that are probably fairly along in the process of being liquidated. So if we can buy this at a discount, and they got it at a 12% discount, so we can pay 88 cents on the dollar, and then in 3, 6, 9 months from now, those positions liquidate, and we're getting that, full 100% or if not more of that back. This could be a nice, return and fairly quick return of capital on it. So it was a good example of kind of that kind of played out as they thought. So it was a good example of kind of where the secondary market, you can get a nice little discount. And if you have some insights of what's going on in those funds, and Bow River is well tied to the private equity market and what various different primary funds are doing, it can help lead to some attractive returns. And so speaking of returns, as we kind of look at their profile, so the fund started in the middle of 2020. You can kind of see their return profile. And as Craig kind of commented, in 2021, you had a phenomenal year. They were up over 30%. 2022, when equity markets were down, 20%. Actually, their fund was up, 6%, not as good as it was the prior year at north of 30, but still a reasonable return. And so you kind of see kind of fairly steady performance. We're going to have good years. We're going to have bad years with this fund, but it's really been one of the better performing funds of the Evergreen group. And we don't just look at past performance, we're really thinking about the drivers going forward. And when we think about what's going to work in private equity going forward and what Bow River is good at in terms of being nimble across secondaries and co-investments, being highly analytical and thoughtful in those investments and analyzing them and then managing the cash flows appropriately, we think that's going to be a great recipe for success going forward as well. So that kind of summarizes, Bow River and the opportunity we have there. I guess the last piece would just be kind of the terms and conditions. So the fund is available for accredited investors or those with net worth of $1 million or more, x your value of your home. It does have a minimum investment size of $50,000. One of the things we like about it and its attractive feature is that Evergreen vehicle is you can allocate capital or buy into the fund once a month. And then on a quarterly basis, you can redeem. And so that redemption is, it's limited to 5% of the fund's value. So if everybody wanted out, you'd only get 5% of your value. But if you're the only investor that wants out and you're less than 5% of the fund, you'd get your entire investment amount back on a quarterly basis. There is what we call a soft lockup. So you can't redeem within the first year without an early redemption penalty of a couple percent, I believe. On the it charges a 1.75% management fee, but different than a lot of private equity funds, there's no performance fee. And so that kind of covers all of their costs. But I would add, and private equity, unfortunately, isn't cheap. I wish it were. But when they are buying into other existing funds, the Bow River fund has to pay the fees to those underlying private equity funds that they're buying into. And so you get 1.26% of additional fees that we call acquired fund fees that they kind of come from that. So when we look at a private equity investment, we're always looking at what is our net of fee return expectation. So these fees have been factored into our return expectations that we talked about earlier. So, and then lastly, just on the tax side, it comes through as a 1099. So it's no K1, no tax reporting hassle. And so for us in general, we really kind of view this as a favorable structure for investors to kind of get that, as Craig astutely commented, that beta exposure, that stable exposure to private equity with good liquidity terms.
The only thing I'll add is real quick, Brock. This slide actually sums up why we're talking about these funds today. They're more accessible. These funds are all more transparent. They're more accessible because the minimum of $50,000 a couple of years ago was significantly higher. The tax reporting was typically K1s for any private investments. So these funds are looking for additional possible investors, opening up the universe to a larger degree of people. And as far as the fees go, the fees are higher in private markets in general. But certainly we think that we're being compensated for the higher fees that we are paying. The last thing I'll say, and we've said this earlier, the risk-adjusted return is what we're focused on here for any allocation we make, public or private, and the complementary nature of private investments with the public securities that we own. Our goal is to improve risk-adjusted returns. And Brock and I have a lot of faith that our team, Matt's team, is doing the due diligence to find those managers in that top decile, top quartile of the private equity space, of the private debt space, of the private real estate space, as we bring these different, fund structures to you and opportunities to you. So just a kind of a comment on how this space has, moved over the years. made it a lot easier and a lot more interesting for us to make an allocation.
Yeah, Matt, thank you for just kind of laying it all out, seeing the universe, and then bring us down to the bottom of the funnel here and just why we're picking these names. You're going to see other names coming through that we're going to show you over time, and they're going to add value in different types of ways. So now we've shown you some on the private credit side. This is on the private equity side. There'll be more on the private real estate side, even though many of our clients have tons of exposure to real estate, but there are other ideas, but this just might not be the time right this moment for some of those ideas. We're going to keep bringing them to you. The due diligence is happening in the background. And when we find, investments that we think fit for clients, we believe this can fit in portfolios for specific clients. We'll have a deeper conversation in our quarterly reviews coming up, or a separate conversation if we want to move sooner. Please reach out to us if you have additional questions, and just thank you for joining today. And thanks again, Matt, for taking the time to explain everything.
Thank you.
All right.
Thank you, Matt.
Thanks, team.